Recording in progress.
The Independent School District will meet in special session at 5:30 p.m. Thursday, March 5th, 2026 in the Administration Building, Room 613, B West Auto Street, Crystal City, Texas. This time, Anna, will you do call roll?
Roll call. Mr. Reynoso.
Present.
Mr. Cruz Mata. Absent. Mr. Sammy Houston.
Here.
Present. Mr. Victor Bonilla III.
Present.
Mr. Gabriel Espinosa.
Here.
Mr. James Martinez.
Here.
And Mrs. Peggy Young.
Here.
We do have a quorum. At this point in time, we're gonna have a moment of reflection. Number 4, public comments for agenda items, sir.
No one, sir.
Thank you. Number 5, discussion action to approve the district annual financial report for the 24-25 school year ending August 31, 2005. Mr. Reed, you're back.
Do you all have copies of the audit?
Sir, we brought in our
For here from last time?
less than copies.
Okay, if you will turn to page 3, this is a certificate of the board where tonight the board will either need to approve or disapprove of this audit, and then we'll get them signed and get them sent to the TEA. On page 5 is our audit opinion. You received an unmodified opinion again this year. This is the best opinion you can receive. That in our opinion, the financial statements are presented fairly in conformity with generally accepted accounting principles. Again, the best opinion you can receive. Starting on page 8 is the management discussion and analysis. This is the same information that's presented in the body of the financial statements, but as we go through here, you'll see it's more of a graphical and narrative format. We have condensed comparisons of your balance sheets from the prior year, condensed comparisons of your income statement from the prior year. Also, if you go through here, you'll see we have pie charts of your revenues and pie charts of your expenditures. So it gives just a different view of the financial statements in a graphical and narrative format. The basic financial statements start on page 16. This is a statement of net position for the governmental activity. This is taking everything for the district as a whole and putting it together in one balance sheet, including all of your fixed assets and all your liabilities. This is on the full accrual method of accounting, which your normal books and records are kept on the modified accrual method of accounting using the fund statements. Top part of our page is our assets, the middle is our deferred outflows and liabilities, and the bottom is our deferred inflows and net position. So as you can see, at the end of the year, we had total assets of $54,419,416. The largest this was in our capital asset activities. You can see that those amounts there are the amounts net of depreciation. So again, that's the largest makeup of your assets is your capital assets. End of the year, we had right at $3 million worth of cash. We had $1.7 million worth of property taxes, net of allowance for doubtful accounts of $200,000. Total assets, $54 million. Our deferred outflows were mainly to deal with our deferred charge on our refunding and then the deferred outflows for pension and other post-employment benefits. Those amounts were, again, these come to us directly from the teacher retirement system, and then we use these numbers to drop into your financial statements. Our total deferred outflows for the year were $8.6 million. Liabilities at the end of the year, we had total liabilities of $53,179,000. You can go down the top of those. We start out with accounts payable. We had just right at $900,000 worth of accounts payable at the end of the year. Going on down, some of the other big items, we had right at $500,000 worth of deferred revenue that had been received, or cash that's been received, but it's revenue to be reported in the next fiscal year. So that was about $500,000. And then we get into our debt portion. We had part of our debt that's due within the next year, $3.8 million. One of the things that we have this year that's new is, every year it seems like the Governmental Accounting Standards Boards put something new that we have to report on. You'll remember we had to start reporting on the pensions and then the other post-employment benefits. Well, now we have the compensated absences that you'll notice on line number 2505, special termination benefits and compensated absences. We're required now to book a liability for your compensated absences if they're more likely than not to occur. So that's what that $127,000 is. That's a new item this year. Then we have our bonds and notes, leases payable. We'll see a breakdown of these later on, but it was like $30,947,000. Then we have our net pension liability and other post-employment benefit liability. Again, these are amounts that come to us directly from the teacher retirement system. The pension liability, $8.7 million, and the other post-employment benefits of $6 million. So our total liabilities were $53,179,000. The deferred inflows coming to us from the teacher retirement system were a total of $7.4 million. When we subtract those deferred inflows and our liabilities from our deferred outflows and our total assets, that gives us our total net position. Our total net position for the year was $2.4 million, of which $13 million was for investment in capital assets net of debt. We had $38,000 that was restricted for state and federal programs. It can only be used for those purposes. Again, $38,000. And then we had restricted for debt service of almost $5.5 million. When we subtract all that, we have a negative unrestricted net assets of $16 million. I'm going to skip the next page because we're going to go into some more detail on our governmental fund balances. On page 18, we have 4 different funds that we consider major programs and major funds that we're required to report on. We have the general fund, the special revenue fund, the debt service fund, and then we still have a little bit of the capital projects funds that's completely terminated by now, but it still had a little of activity, so that's included in. Under the general fund, we had total assets at the end of the year of $2.9 million. Our accounts payable and liabilities for the year were $4.1 million. The deferred revenue is the amount of the offset to our property taxes, net of allowance for doubtful accounts of $1,151,000. So when we subtract our deferred inflows and our liabilities from our assets at the end of the year, we're still sitting with a negative fund balance. That negative fund balance this year is $2.3 million. And we'll get into a breakdown of the increases and decreases here in a minute. The special revenue fund, this is where we have all of our federal programs. Normally these are pretty much self-balancing. At the end of the year, we still had $120,000 worth of assets, $81,000 worth of liabilities, and so we had a $38,900 fund balance that was restricted. That money can only be spent for state and federal programs. Then the debt service fund. We had total assets of $5.9 million. Our liabilities and deferred inflows were $1,500 and then $401,000 for our deferred unavailable revenues. So when we subtract that, we still have a fund balance in our debt service fund of $5,499,000. There were no assets or liabilities in the capital projects fund. If you'll turn a couple of pages and go to page 22, This is looking at the statement of revenues, expenditures, and changes in fund balances for those same funds, the general fund, the special revenue, debt service, and capital projects. Top part of our page is our revenues, middle is our expenditures and other financing sources, and then we get down to the bottom is our fund balances. Going down the general fund, we had total revenues for the year of $20,445,899. Our expenditures were $23,086,001. So we actually had a excess expenditures over our revenues for the year of $2.6 million. Now, we did have some other financing sources. If you'll remember, we had a short-term loan this year, so that was where we achieved $1.4 million worth of loan proceeds, which is another source of income. We had transfers out to other funds, $1,186,000, and then we also had some capital leases. But the net other financing sources were $481,000. Then underneath that, we'll see we have this extraordinary item. If you'll remember, we had the lawsuit collection this last year. That was $1.2 million. So when we take all those things into account, with the $1.4 million worth of loan proceeds, plus the $1,200,000 worth of lawsuit settlements, we still almost about $1 million in the hole with those things even happen. And without those, we still would have been with a deficit of $2.6 million. So we're not seeing again, I think most all of you were exposed to this about this time last year. So we had really only about 8 months, for this fiscal year to try to correct the ship. But it's as a board, you're going to have to start probably trying to make some serious changes and things to start addressing this, because I don't know where you stand right now, but this is something that we've got to start addressing this negative fund balance and start trying to do something to whittle away at it. Going in the hole another $2.6 million is not, we're not getting where we need to go with that. So just bring that to your attention. The special revenue fund, we had total revenues of $2.5 million. We had expenditures of $2.4 million, which is what we expect. Your special revenue fund should be a self-balancing, with the exception of some of the state programs. All of your federal programs, our revenues and expenses are matched one for one. So the bottom line on that is we had a change in our fund balance of $46,000. The debt service fund. In the debt service fund, we had total revenues of $5.4 million. Our expenditures were $3.7 million for principal on our debt, our long-term debt, and interest and bond cost. That's something that I've talked to Ms. Briones about and the staff, is that we're collecting a lot of money in our debt service fund, more than we really need, because if you look at what you're bringing in, $5.4 million as opposed to the needs, the debt service needs of $3.7, we're building that fund balance up in the debt service program, which can only be spent. It's restricted, can only be used to service your debt. So we've talked about some ways of possibly reducing your debt service tax rate to be able to maybe raise your M&O tax rate, but you're still going to be subject to the laws of not going over the certain amount, or otherwise having to have a rollback election. But gives you some options to be able to possibly make it more palatable to lower one and raise one, and still make it where it's not as harmful for the taxpayers. But I suggest that with our meeting that you might try to get somebody that knows the ins and outs of tax rates, the laws on that, and what you can and can't do to try to structure this so it might help you out a little bit better. But again, just collecting taxes here, all we're doing is building up a fund so that in our final years we won't need to actually assess any taxes to pay it off, because I looked at your schedule of maturities, and pretty much your debt service is going to stay the same all the way through. So we're going to need about that $3.7 million every year to pay for it. So just don't see the need raising the revenues to have an excess there. Capital Projects Fund, we're still trying to close that thing out, and we finally did this year. Had a little bit of revenue on that, and the total amount was transferred out, so it is officially closed down now. I'd like to turn to page 28. This is your schedule of fiduciary funds. We are holding money for various different student activity groups. This is not our money as the district, but we're required to report on it. And we had $88,000 worth of funds that we were holding that belonged to others. On the next page, on page 29, that shows that our fundraising activities brought in $123,000. We spent $126,000. So we subtracted that off to arrive at our ending net position of $85,000. Starting on page 30 are the notes of the financial statements. These are the notes that are required by general accepted accounting principles. Every year these get longer and longer, but I do want to go through a few of these with you. If you'll turn to page 38, especially the schedule there at the top, the interfund receivables. One of the things that we've talked about in the past, if you'll look in the middle of that page there, the debt service fund still has $2.7 million that is owed back to the general fund. And as we'll see later on, what we talked about last year, that is you're not in compliance by doing that. That again, these debt service funds should only be spent for debt service and nothing else. And borrowing from it is a violation of state laws, which we've talked about last year. It's still going on. So you're going to continue to get that from us until that changes, though. On page 39, short-term debt just shows the terms of that. We did borrow $1.4 million, and it was to be matured like right now. I'm assuming they didn't get paid back, so it gets paid back. So as of now, that's no longer there. If you'll turn to page 41, page 40 towards the middle of the page, the changes in long-term debt. This shows you what our various different types of long-term debt were at the beginning of the year, what our increases were, our decreases, and our ending fund balance, and then the amounts due within 1 year. And then on page 41 gives you a detail of each one of those bonds that makes up our total outstanding amount of $33,245. What I was talking about earlier is if you look at we're required to present your debt service requirements for 5 years and then in 5-year increments thereafter. So you can see that those amounts are staying pretty constant. So I think it would be wise for you to try to, maybe lower your debt service revenue tax rate so that, we only have to collect the amounts that we're actually needing to fund the debt service for that year. That's a good thing about it. Like I say, even though we do have a negative fund balance, I mean, I'm not saying you're lucky, but you had if you didn't have that debt service to bar fund, even though it was illegal, you would be in really bad shape now. So. That's pretty much it for the notes of the financial statements. I will ask you to turn towards the end. Turn to page 53. We're required to list the unfavorable budget variances that you had for the year. They're not as much as they were last year. I think last year we were looking at every one of your different functions you had exceeded your budget on. It's not as bad as it was, but we still have some pretty significant budget variances there. In note T, the use of the debt service fund, we're still pointing out that, we have a borrowing money from the debt service, which is an illegal act there of $2.7 million. And that, we're still have the negative fund balances in the general fund and the internal services fund. Again, gives you the breakdown of those fund balance amounts there. No, on page 54, because we had the implementation of the compensated absences, we're required to bring in $21,137,000 worth of revenue. We actually brought in $20,445,000. So we have an unfavorable budget variance on our revenues of $692,000. On the expenditures, we had anticipated that we were going to bring in $22,611,000. We spent $22,611,000. We actually spent $23,086,000. So we have an unfavorable variance there of $474,000. So, like I said, at the end of the year, we had anticipated that we were going to have basically a $46,000 decrease in our change in our fund balance, where we actually had a $944,000 decrease in our fund balance. That's another thing I'd like to point out is that, if you look at that final amended budget, we have a deficit fund balance, and yet we're budgeting ourselves a deficit for the year too. So that's not something that's allowed to do. You can't budget yourself a deficit unless you have a fund balance to offset that deficit. So in this case, where you had a negative fund balance to begin with, you should never budget yourself a deficit. Only if you have a positive fund balance to be able to offset that. If you will turn to page 64, this is the schedule of delinquent taxes receivable. This shows what your tax rates have been for the last 10 years, what your assessed values have been for the last 10 years, what our original property tax receivable was at the beginning of the year, the levy, collections, and then what we finally have at the end of the year. This is good information because it tells you kind of where your tax rates have been and where they're going. When you look at what our assessed value is, we're looking at a $1.5 billion assessed value, where 10 years ago we were at $836 million. So it's a pretty sizable increase in our assessed value. Of the $15 million that we levied for the current year, we have collected all but $431,000. One of the things that kind of strikes me is that, when you look at our total receivable, their property tax receivable, $1.7 million, that's kind of high compared to most of our school districts. You would think that, there would be your collection attorneys, that are hired, I guess by the appraisal district, would probably start pursuing some of these to try to get those, because property taxes will not be written off. You can't just write them off, but that property, if someone hadn't paid their taxes, you'll have to file suit on them, and usually that needs to then go to the courthouse, and it's usually sold on the courthouse lawn, and then the proceeds come back to you. But eventually you'll get that money, even if there's a judgment on it, and when the property is eventually sold or transferred, it'll have to be paid first. But might want to get with the appraisal district and make sure that they're pursuing those delinquent taxes.
We have 3 members from the board that are in the appraisal district.
Then on page 66, we have to present a budget for the nutrition program, and this is what this schedule is doing. For the most part, like I say, this came in. We still had excess revenues over expenditures, but in total, we had basically a $1 variance. So it came in exactly as we expected. The next page, on page 68, is the schedule for debt service, the budget comparison for it. One thing you'll notice that there was not an original budget. You know, the debt service was never budgeted for originally when you prepared your budget, which should have happened. You did come in and amend your budget to later on during the year, but this is part of the things that were going on that, you know, at the end of last year that we're just now getting corrected. When the budget amounts were actually put in, we have an excess favorable budget variance on our revenues of $706,000. A favorable budget variance on our expenditures of $208,000. So again, we were budgeting ourselves to have excess revenues when really we didn't need to have that. So try to tighten that up a little bit more, I guess is what I'd try to say. Okay, starting with page 71 and forward, this gets into our single audit portion of the audit. Because you receive over $750,000 worth of federal funds, we're required to do what's called a single audit. And part of it is we have to give you an opinion overall on your compliance and internal controls over all programs and any state programs, and that's what this page on 73 and 74 is. And if you'll notice in the last paragraph on page 73, that it does say that we did identify deficiencies in your internal control that we are describing on the accompanying schedule of finding and question costs. We'll get to those in a minute. We also, on the next page, 74, that first paragraph says that our test disclosed instances of non-compliance, which we were going to be describing in these accompanying scheduled question costs. Again, those are all state internal control and compliance issues. They're not federal. So therefore, the next opinion letter we have on page 75, since we are having a single audit, we're required to pick our programs to make up an amount that satisfies our needs to be able to be classified as major programs. And this year, we had to select let's see what it was. I can't remember off the top of my head. We had to choose your Title I program and your child nutrition programs as your major program. So on those programs, we did more extensive testing on your compliance and your internal controls. And on this paragraph, opinion letter on page 75 and 76 and 77, this is stating that we disclose no instances of non-compliance and your internal controls over the federal programs for the major programs were adequate. Now we get into page 78, which has our schedule of findings and question costs. And if you'll look on page 79, these are the same findings that we found last year. So they haven't changed. Finding number one is that we had an excessive amount of adjusting our journal entries, and that's anytime we have a large amount of adjusting our journal entries, that tells us that your internal controls are not adequate, because when we get your financial statements, they should be in an audit-ready format. So I think that, again, changes happen, but they happen, halfway during the year. So I hope that, in next year's audit, those things are corrected. Finding number two is on the negative fund balances. At the end of the year, we had $2.3 million worth of negative fund balance in the general fund, and the total services fund had a negative fund balance of $1,138,000. Again, that is a violation of state law, so we're going to have to work on getting that corrected. Same finding, again, these are all repeat findings from the prior year. Finding number three on page 80, budgetary compliance. We didn't amend our budget. We had excess revenues, expenditures over revenues in our general fund by $474,000. Also, as I mentioned earlier, you adopted a deficit budget without having a positive fund balance to cover that deficit budget. So again, that is something that, when you prepare your budgets, you got to look at, and you can't budget yourself a deficit until we get this negative fund balance taken care of. Then on finding number 4, again, this is the borrowing of money from the debt service fund that, at the end of the year, that was 2.7 million. That's up from what it was. That there was some additional borrowing from the debt service fund that incurred, even during this fiscal year. So that, again, needs to be repaid. So what you've got is about a $4 million problem, because we've got a negative fund balance of 2.7 million, plus we have the amount of money that's got to be paid back to the debt service fund. So, you've got to really start, and again, unfortunately, there's only 2 ways to get this done. We are both. We either have to raise our revenues or cut our expenses, or do both. But, we've got to start working on that, coming up with a plan. And I think Ms. Baroni has told me that, she's working on plans to try to implement this for the future to see how that happens. But, it's no different than at home. You get yourself into credit card debt. It takes forever to get, it's real fast to get there, but it takes forever to get out of it. But we got to come up with a plan to move forward so that we can start chipping away at this. So those are our findings and question calls. And again, if you look at the summary of schedule of prior auditing findings, these are the same findings, they just were repeated from 24. On page 85, this shows our schedule of expenditures of federal awards. This shows the various different programs where we received our federal awards from. Total federal programs was $2,074,000. Now, I would like you to, in the front of your audit, there should be some individual sheets, letters presented to the board. Do y'all have those?
Yes.
We don't have one.
You don't have them?
Certificate of board sheet? Is it called a certificate of board?
No, these would just be individuals that are inside by themselves.
That one? It's inside those. I didn't get a copy of that one.
Yeah. This is our management letter to the board. It's basically telling you what we found. A lot of this that we have already discussed, but I again, would kind of like to go over this a little bit more in detail. Number 1, we had numerous audit adjustment entries, and most of those were in our federal funds. And what we would propose you do is to try to do a little bit better job of trying to reconcile your federal programs at the end of the year. I think we still had several programs that had we could have gotten reimbursement from that we didn't, so need to monitor those federal programs a little better. Number 2 is that we had over 24 adjusting journal entries, which again, we're one of the things that when we see that many journal entries, it tells us that your internal control structure is not working right. Number 3 is the negative fund balance. Again, that, it's a violation of state law to have your negative fund balance. Number 4, the budget variances. Again, these comments we're kind of repeating ourselves, but we're required to do this in the management letter also. Number 5, we talked about this before, the debt service fund borrowing is a violation of state law. 6, we haven't discussed before, but the district underspent its state allotment for its intent code, 37 dyslexia allotment, 24 compensatory education allotment, and the career and technology allotment, and the gifted and talented allotment. So there were several state allotment required spendings that were not being, and you'll probably be receiving some nasty grams from TEA over that.
With these, is there a possibility of losing this amount of money in the upcoming year? Like if, hey, you didn't use it, you don't need it?
I don't think you're going to lose it, but they're going to tell you that, you're supposed to spend it. And like I say, that's out of my area. I just know that this is what they say you're supposed to spend, and I don't know what happens if you don't. I have had instances where I've seen them, they'll send you a nasty letter and tell you that you start, of course, spend it in the right areas. And it's, your comp ed allotment, underspending that by $533,000. I don't know what happened, but in the prior year, you were way overspent. And this year you were way underspent. So I don't know what happened to that, but it's, be expecting, like I say, a lot of bad news. The one thing that, like I say, I'm a little disappointed in is that, I thought with, this massive thing was undercovered about this time, or about January of last year. And I was expecting that, there would have been more actions to try to mitigate things. And, that's what I'm trying to hammer home to you, is that we've got to start making some serious, probably unpopular decisions to start at least chipping away at this, because, this is not sustainable. I think you were able to get by this last year with the short-term borrowing, but that's just a Band-Aid. It's not fixing anything. It's just helping with cash flow. So, questions?
You mentioned that the 2.7 million that was transferred from the funds, I guess.
Yes.
You mentioned that it had increased from last year. Do you have a number of how much it increased from the year before?
I can't exactly tell you. I can get that number for you, but I don't have it with me. It wasn't massive, because if it was anything, it was like $300,000 or $400,000. And again, a lot of that is because, we're talking about the end of August last year, when a lot of this stopped about January. So there could have still been some before it was actually brought to light, that then it stopped after that.
Joni, any questions?
No.
Tommy? I don't. Peggy? You know? Thank you, sir, and you looking at very hard at recommendations that you have submitted to us in the past couple of years.
Like I say, if you have any questions during the year, or need to bounce some ideas off of us, we're there to help in any way. But it's not going to be fun, but like I say, it's something that's going to have to start being addressed, because it just has to. So.
Okay, if there's any more questions.
Thank you, Mr. Eads.
Yeah, I have to get the approved, and I have to sign. The certification, this one.
We're gonna go ahead and vote on, or you need something else?
Are you going to approve this, or?
Yes, we're gonna vote, the next action item, under 5A, discussion to, action to approve the district annual financial report for the 2024-25 school year, and then August 31, 2025. Do I have a motion to approve?
I'll make it.
Ms. Young, motions to approve?
Second.
Second by Mr. Easton. Questions, concerns? Not all in favor? You have it, sir.
You have to get this submitted.
Martin, see if you can sign.
Okay, I'm gonna leave this with you and get him to sign it. As soon as possible, get that back. Okay, all right.
Thank you, sir.
Thank you very much. Thank you.
Just got on.
Yeah, but he has to sign it.
Yeah, well, I mean, I just wanted to, for the record, Mr. Mata did sign on via,
Oh, okay. Logged in by 5:38. 5:38.
Mr. Mata,
Yeah,
will you be able to stop by central office tomorrow and sign the things that we have to sign for the audit? We're past you and he needs to sign. Or,
yeah, I can sign it before, I can sign it before I take off to work.
okay, what time is that?
I can be there at 8 o'clock.
We'll be ready. Yes, we'll be here.
We'll have it, stop by, I mean, just a signature that we need, and, we can send it to Mr. Reed.
I mean, if they're there earlier, I can be there by 7:30.
We're here by 7:30.
Yeah, I can be there by 7:30.
Okay.
All right. Thank you, sir. Safe travel.
I want to, are we going to closed session?
Before, we continue with the meeting, and I was supposed to do it, before, we have, two of our conservators are gonna be working, for the school district. Ms. Hernandez, at this time for the rest of the board, can you?
Yes, so if you all would like to come up, Mr. Hines, Dr. Reina. John Hines is conservator that is working primarily with campus principals, and Dr. Sylvia Reina, as far as my understanding, Dr. Reina, you'll be working with the team of 8,
Yes,
the board and the team of 8.
in a nutshell, yes, and good afternoon, everyone, and also to the guests. I am Sylvia Reina, and I am, have been appointed by Texas Education Agency to be the conservator for the district. And because we have different areas of expertise, Mr. John Hines, introduce yourself.
I'm John Hines. I'm going to be the co-conservator, and I'll be mainly working with the campus administration.
You have already started, right? Your Monday, and then you met also with, TR, Child Elementary, with staff.
And my area is to work with the board, the governance, and the cabinet level individuals to deal with the system as a whole, and how is it that it's operating, and how is it that we can make it efficient and in accordance with all of the Texas education rules and regulations. So I'll just say I'm pleased to be here. I'm at your service and certainly want to help you in any way that you can. And if you identify anything specific, please let us know. But again, those are our areas, and know that any time that you need something of information, if we don't know it and can't give it to you, we will certainly get it for you, because the goal is to ensure that you have a successful school year and that our students are successful here.
Do you all have like a schedule? I mean, when the teachers know that you're gonna be on the campus, it's gonna be different every week, or I know you mentioned Monday, Tuesday, and Tuesday with the month, so they already know. Do you have?
And my schedule is a little different, because my first entry point is going to be to have and set an appointment to speak with you, interview each one of you individually. So I'll work around your schedules, work, or whatever it is that you have as an obligation, such that we can get to know each other and then get from your perspective what is it that needs to be done, and such that we can create those opportunities for success. And so it's a little different in that I will be here on as need basis, and also will attend all of your board meetings so that we can make those presentations and give you an update as to what we're doing and how we have progressed throughout our stay here. Again, Zoom is very easy to get in touch with us. We also are available by phone. So anytime that you have any kind of question regarding any areas, because we both have expertise in the entire school system, but because we want to concentrate and take care of your your schedules as well as ours, we've kind of split those duties up. So as far as specific dates and times, no, but certainly we'll let the superintendent and you all know when we're going to be here.
Check on our
Yes.
working schedule.
At every board meeting, we will give you an update.
Any questions for them, the board? We welcome you, I mean, and we accept every, help that we can give us and that you identified, especially, I mean, at the, that you're gonna be working with the, mostly with Benito Juarez, one thing as a board member and as an ex-principal, I know sometimes, we blame the school up here, but we also need to check what's happening at the foundation so that what are our kinder students doing? The first grade doing, third, so that when they go to the Benito Juarez, they're prepared. And that's something that I would really ask from you guys to make sure that our kids, I mean, we're learning at the, that area. And so, but we'll be around, call us if you need anything with the superintendent or Mr. Spinoza.
So you will notify us by email or you go through central office so they can notify us when you want to meet with us one-on-one?
I've already met with Ms. Briones to be able to discuss, to contact you all, what's available for your schedule such that we can have those one-on-one interviews. So again, I want to be as flexible as possible because I don't work and have obligations, family, et cetera. So whatever's convenient, as much as I can do it in person, I will be here. And if not, then we can certainly talk. But it's going to be hopefully a good relationship that we want the doors to be open and the phone lines to be open such that we can work together. So.
Thank you.
Thank you.
Good.
Thank you.
Thank you, ma'am.
Thank you.
sir.
Y'all.
We're gonna
Do you want to do personal matters first?
do personal matters with you, and then when we get to, this point in time, I don't know what's the time for, going into, closed session.
It's 6:20.
So,
Want to read the statement?
yes. Board trustees will meet in closed session as authorized by the Texas Government Code, Chapter 551, and the Open Meeting Act.
And it's 6:20.
Okay.
Recording stopped.